Hello and welcome to this week's episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the week ahead. So before we get on to the main event of this week, which was the US Federal Reserve interest rate decision, let's do a quick recap. We're at the point with investment markets where Donald Trump has stopped rocking the boat. The trade war is just simmering in the background. We've had some negotiations ongoing with nothing really coming out of them. We've had US earnings and earnings across the globe coming in. Generally speaking, they've been better than expected, or perhaps I should say not as bad as feared. So in America, for example, they're about 5% higher than analysts' expectations. So we've seen markets largely flatline for most of the past few weeks. This week, in terms of central banks, we had the Bank of Japan release its interest rate decision, which was to do nothing, which happened to be the same as what the Bank of England did this week. But the Bank of England raised the alarm over a potential Brexit no deal and the impact that could have on UK GDP and therefore the outlook for future interest rate cuts. But the main event was the US Federal Reserve rate decision. Now, leading up to this, the market had priced in a certainty that the Fed would cut interest rates. If they didn't, then we were likely going to get a market wobble. Stock markets would most likely have fallen. Now, the market priced in an 80% chance that the Fed would cut interest rates at 0.25% and only a 20% chance that it would cut it by 0.5%. As it happened, the Fed cut by 0.25%. But if you look at the stock market after the announcement, you'd be forgiven for wondering why the market was so disappointed with the 0.25% cut, given that that was what they'd priced in. Now, the answer lies in the press conference that happens after the whole release. So Jerome Powell, who is the chair of the US Federal Reserve, did his usual press conference and answered questions. And it was during that he made a couple of points that caused a bit of alarm. He suggested that this wouldn't be the first of many interest rate cuts. He said it was indicative of a rate cut in a mid-cycle. So what he was trying to say there is that the economy wasn't about to fall off a cliff. We weren't at the point where economic expansion was starting to really contract and we were going to therefore get lots of interest rate rises. This was just something to sort of bit of an insurance policy. The market didn't like that. The market is banking on the Fed having their back to boost the US economy and by default the US stock market. So immediately after those comments, we saw some wild moves in US markets. The rest of the global stock market was closed. So immediately after those comments, we saw the S&P 500 fall by 1.8%. We saw the VIX spike above 15, which is a key level because normally above 15 is bad for stock markets, whereas under 15 is generally seen as a good sign for stock markets. We saw the treasury yields come down a little bit. So what we saw was a bit more panic and uncertainty, but there was a lot of volatility because as the press conference went on, Jerome Powell must have had some inkling of what he'd done and started to backtrack. And as he backtracked, so did the market's reaction backtrack. And they weren't as scared as they were initially. And the S&P 500 ended up finishing down around 1%. As I make this video, it's very early days. We don't know quite how the market's going to take what happened with the Fed. Some people are using terms like a hawkish cut, which is a very odd term to use, but basically it wasn't as dovish as they'd hoped. It was a interest rate cut, basically the minimum they could have got away with without scaring the market, but not, as I said, indicating there would be lots more interest rate cuts in the future. So that has been taken as a slightly negative sign, and some people have taken some profits out of the stock market. What will be interesting is the upcoming jobs report we get on Friday in America. Now, that will give some signs as to how strong the US economy is at the moment, and of course, if it proves to be stronger than expected, that may lead the stock market to believe that actually no more interest rate cuts are going to come. And Powell is maybe right that this isn't a late cycle stage. So there's a lot to keep an eye on towards the end of this week and how the market reacts. So don't forget, if we jump back to the autumn, although it's a slightly different environment that the Fed was actually starting to increase interest rates, the initial disappointment after the comments made back then about interest rate paths and where the interest rates were likely to be in the future, It wasn't as violent as this subsequent reaction a couple of weeks later once the market had digested everything. So let's hope we don't get the same reaction this time around. But perhaps for anybody who's an investor who lives in the UK, the biggest story is, of course, Boris Johnson becoming the UK Prime Minister and the fallout of that, because since he's become Prime Minister, the pound has fallen through the floor. We've got below the $1.21 level, and that is the lowest level we've had pretty much since the Brexit referendum. That's because Boris Johnson seems hell-bent in taking the UK out of the European Union by the end of October, even if that means a no deal. So as a result, what you're seeing is the pound sell-off. You're seeing anything that's UK focused, so any companies that get most of their earnings from the UK, so think FTSE 250, they've done badly, but anything that's exposed to overseas earnings, so FTSE 100 companies are doing very well from the weak pound, but of course also your overseas holdings have done really well. If you go back now and look at July in isolation, for a UK investor with overseas exposure, you've done really well because the pound has fallen by about 4 or 5%, as I say, during the month. Going forward, that means politics is going to play a huge part in your investment portfolio and the returns that you are likely to see. So as we head towards that October deadline, then we're going to see a lot of volatility in the pound. We're going to see probably a lot of volatility in equity markets, particularly in the UK, but also in Europe. Now, over the course of these videos, and particularly for 80/20 investor members, we're going to do a lot about perhaps the Brexit playbook and the lead up towards that vote. So what would happen? What could happen with markets? We don't really know because we don't know what the deal will be. But as a hint, go back and look what happened in 2016 around the Brexit referendum. How did certain assets behave? If you look at those, you'll get an inkling into how assets might behave in the lead up to the end of October. So that is it for this week. Those of you who are 80/20 investor members, the new data is out, the new best of the best selection, and you've also just received a research piece where I looked at the daily moves of the S&P 500 for every day since 1950 to show you and understand what markets do when we hit all-time highs, as we have been in recent times. And it's not quite what people think. So make sure you check that out. Go to the website and you can get a free trial if you're not already a member. As usual, you can contact me at Damien@moneytothemasses.com and via social media, Twitter, Money to the Masses with the number 2, and via Instagram, Money to the Masses.